Hello, my name is Ken Moore with Global View Investment Advisors, and the topic today is help your clients avoid losing money they can't get back, making this presentation to referral partners of ours. At Global View, we believe you deserve to be worry-free because Carl Pelmer discovered that the number one wish elders have at the end of their life is that they wish they hadn't spent so much of their life worrying. So we've developed something we call worry-free portfolio management. It's a process that's not risk-free. Instead, it's a reasoned and logical collaborative process where we first eliminate conflicts of interest. Second, focus on investing in fundamentals like either fundamental indexes or moats or true value investing. We coach our clients so that they can get to where they need to be by identifying the risk they're taking and then helping them to understand what this risk and what it will occur, and then finally to make the right life choices. So Daniel Kahneman won the Nobel Prize in 2002 for discovering that not only are we as human beings irrational, we're nearly perfectly and predictably irrational. So as financial advisors, our job is to make sure that we help guide clients to do things in their best interest. In fact, he says that financial advising is a prescriptive activity whose main objective should be to guide investors to make decisions that serve their best interests. Now, we're talking about today a new Department of Labor fiduciary rule where, if passed, will have a huge impact on the industry of financial advice as of April 10th of 2017. Before this rule was passed, the President commissioned a study by his Council of Economic Advisors that found that conflicted advice costs advisors 1% per year and makes them run out of money 5 years early. I also think it's important to highlight the fact that investors are not doing a good job. In fact, investors, based on the cash flow of the investments that they actually made in the world's largest equity index, the S&P 500 fund, retail investors in this fund made 3.2% per year for the last 15 years, when the market itself made 5.4% total return, including dividends. So I feel like it's a good time to tell your clients to roll over their 401k when most of the investments in that 401k are funds that very closely approximate the S&P 500 index. So the new rule is all about helping to manage conflicts of interests, and there's a lot of confusion in the industry. Most people feel that fee-based advisors are conflict-free, but it's not true at all. In fact, fee-based advisors may receive insurance and brokerage commissions and may receive revenue-sharing kickbacks from funds that have hidden contracts with the brokerage firms where they work. These can be huge in some cases, and in fact, inside of variable insurance contracts, we found them to be 60 basis points or higher. The only way you can truly avoid most, but all conflicts of interest is to work with a pure level fee or a fee-only advisor who only receives fees from the client. So it's not true, in fact, even that these guys have no conflicts of interest, because of course they have a conflict of interest. The conflict of interest is that they believe that through their combination of services and identifying investments and where to put the investments and coaching and etc., that they can improve the odds of the client to reach his goals. So their conflict then is to encourage the prospective client to move funds to them, specifically, for instance, to move their 401k over into an IRA they can manage. So regarding investing, the world is a risky place. We talked about it a minute ago. The average investor in the world's largest equity fund made 3.2% on a 15-year basis. So if we look at the actual S&P 500 total return chart, including dividends, and we see what happened from 2000 to 2002, we know there was a 38% loss. And from 2007 to 2009, there was a 55% loss. So if you invested in 2000, you would have been down until 2006. And then you would have been back up, but you would have been down again until 2011. So it was an 11-year period you were down. If you invested in 2007, you would have been back in 2012. Again, you were down for 5 years. In fact, in 2009, stocks fell to 1996 levels. Well, a lot of investors in a lot of 401k plans around the country and a lot of funds that look a lot like the S&P 500 index, because these funds, when they get to size above 20 billion or so, almost inevitably have to look like the S&P 500 index. And also the way that the companies are managed forces the managers of these larger funds in particular to manage other people's money instead of their own money, and to lose sight of the primary objective, which is to avoid permanent loss of capital. So investors in IRAs and 401ks overall only made 3.2% per year for the last 15 years total return. And now we have a lot of investors moving into index funds. In fact, over one-third of all equity investments now are in index funds. People are taking risks that they don't know they're taking, and it's a perfect time for them to think about doing something a little bit differently. The reason why investors make 3.2% for the last 15 years is very simple. People are human beings. We're encumbered with this hindbrain. Instead of making system 2 type choices, as Daniel Kahneman calls this from his book Thinking Fast and Slow, instead of thinking slowly, deliberatively, analytically, and logically, human beings think quickly, automatically, impulsively, associatively, emotionally, unconsciously. We use our hindbrain to make decisions. We use the crocodile brain to make decisions. So as an advisor then, our job is to tame this crocodile. So I like to show clients a game that Daniel Kahneman created. The game is this. On day one, I come to you. I'm going to give you 2 choices. Choice A, give me $3,000. Choice B, play a game. In this game, there's an 80% chance you have to give me $4,000, but a 20% chance you have to give me nothing. Which choice do you take? Second day, I'm coming bearing flowers. I'm going to give you 2 choices also. Choice C is I'm going to give you $3,000. Or choice D. Again, I can allow you to play a game. This time, you have a chance of winning $4,000. 80% chance, 20% chance of winning nothing. Which do you choose? Okay, so now that you know what your choice is, let's look to see what people chose. On day one, 92% of people made the wrong choice. Instead of choosing to lose $3,000, they chose to lose $3,200, which is the loss associated with minus 0.8 times 4,000, minus 3,200. Wrong choice. Should have chosen A. Day 2, people chose to take the gamble only 20% of the time, when the gamble this time has a higher expected value. 0.8 times 4,000 is 3,200. So 80% of people made the wrong choice on day 2. 92% of people made the wrong choice on day 1. Shows a couple of things. First of all, we're irrational largely. Second of all, we'll take more risk to avoid a loss than we would to make a gain. Is we like to show them that based on the risk assessment, which is a psychometric test. I'm sorry guys, it takes 15 or 20 minutes to take this test, not 5. It takes a little longer, it's worth it. We're going to use this test to manage your allocation to risk. And once we know what your allocation to risk is, well, if you come out to be a medium risk guy and you go into what we call our portfolio 4, just very generically, and that portfolio 4 takes half the risk of the market, then you would expect to be down half as much as the market on a given 6-month period. So you'd be down 10.5% or up 14% over a given 6-month period at 95% confidence, versus the market taking all risk, minus 21 up 28. That's 95% confidence. Portfolio 5, where you're taking a little over 2/3 of the risk, you'd be down 15% or up 20. Similarly, if we did portfolio 3, you'd be down even less and up less. So, again, part of our job with WorryFree Portfolio Management is to help clients make the right life choices. Again, financial advising is a prescriptive activity whose main objective should be to guide investors to make decisions that serve their best interests. So, what are some of the choices that people make? And let's just go through some cases. So, one of the choices that young people in their 30s, 40s, 50s sometimes are wooed into making is to invest in whole life insurance. And guys, let me tell you, I worked on Wall Street for American International Group in the 90s, and one of my jobs was to find companies for AIG to buy. And for me to know which companies to buy, I looked for companies that made money underwriting, because every company and insurance company makes money investing. You make money investing by using system two. You think logically about this. You take in premiums from people and hold them for a very long time. You invest that into, largely when it's whole life insurance, corporate bonds. 95% or more is in corporate bonds. You make on that whatever the return is going to be in corporate bonds, and you pay out less to the people who are giving you the premiums. Okay, whether you're a mutual company, whether you're a public company, whatever kind of company, you've got to make money on the investing. Everybody pretty much does that. So if you can make money on the underwriting too, in other words, pay out less claims than you take in premiums, boy, you get a profitable business. Not a good game for someone for investing. The second choice I want to show you is an older couple who we did estate planning with many years ago, and I've learned a lot since then, who we decided we needed to do a revocable living trust because they had sizable assets outside of their IRA assets, so individual accounts that were sizable. We felt that if we put them into a revocable living trust, we could bypass probate. Well, so the accounts that we held at TD Ameritrade, we put into these revocable living trusts. However, she had other accounts at Vanguard, and they didn't want to move these accounts because these are assets they inherited from their parents, and so they never wanted to sell them, and they didn't want to manage them, and they didn't want to move them to us. We offered to move them to us. We weren't going to bill them for doing so that we could put them into a revocable living trust. But what happened? Well, he passed away. When he passed away, I saw, even though my older client had told me that they had been put into a trust, it wasn't true. They had never been put into a trust. So now we have to deal with this as the client. And now we're being a lot more pushy about moving these assets over so that we can ensure that the life choice that was made is effectively implemented and manifest. Third one, PhD in biotech, put $1 million of $2 million that the person owns into an index annuity because his accountant recommended it. Well, the accountant forgot to tell him, and the insurance salesman forgot to tell this person that this annuity was designed many years ago to produce the return of a certificate of a deposit. So 2.5% return designed to do. He did tell him, though, that he could participate in the upside of the market, that he wouldn't lose any money if he kept it there for 10 years. It would be, no contract guarantee to get the money back, etc. If you put your money 60% in the stock market, 40% in treasury bonds, there's never been a 10-year period when it didn't make money. So this kind of insurance, in my opinion, is like selling flood insurance to somebody who owns a mountain house. You don't need it on a 10-year basis. Or you haven't, I should say. Who knows about the future? The physiatrist, making $2 million a year, sold First Eagle in 1999 and Grander Peak in 2016 because the asset class itself, it's been a crazy market. Market cap indexes with Facebook, Amazon, Netflix, Google have done very well vis-a-vis some of the other international strategies or international indexes, and small cap, particularly outside of the United States. So it's been a very difficult time to make money in those, even if you are a 5-star and rated best in your class. And recently I had a retiree who wanted to move into an assisted living facility. Okay, his choice was A, that he just pays $120,000. I'm making very simplistic assumptions here. $120,000 could go into the home. B, he could pay $200,000, and at the end of his life and his wife's life, there'd be $100,000 paid back. Or C, he could pay $400,000, and he'd get 90% of that back. So we looked at this because it's really just an interest rate problem to solve the rate. First of all, we have to assume a life expectancy for him and his wife, and we did that. We said it was 13 years. And then we have to say, okay, you're putting this amount of money in, and it's not the $120,000, it's really the $200,000. So you're putting the difference between $80,000. You've got to do the first one to even get the home. So it's really, we're looking at the marginal difference. So if you pay $80,000 and you get it back in 13 years, half of that, or half of what you would have put in, that's really, you get back $100,000 or so. That's about a 5.5% annual return. So that's what we're looking at, 5.5% for 13 years. Is that something that you think makes sense or not? Okay. Or we could look at choice B. Choice C, we did the same math on that one, and choice C came out to be a much lower return. It came out to be a little over 3%. So choice C was not a viable choice, but choice B is potentially a viable choice. Choice B would choose if your risk tolerance makes sense for you to do that. In other words, if you're a medium risk guy, yeah, you probably could, hope to try to make more than 5% per year. This client was, so he chose then to go ahead with the proceeds of his house sale to give to us to invest. Because remember, I have a conflict of interest here, and as a fiduciary, I want to make sure that it is in your best interest. If it were in his best interest to keep it in the 5.5% that he'd probably get, if he lived longer, it'd be less. Didn't live as long, it'd be more. But we did this in a logical framework, like a prudent man would as an outsider. So, major studies confirm that advisors add value. Vanguard says advisors add about 3% per year, and that 1.5% of that or so comes from coaching. So, they recognize that investors don't make, human beings don't make good investors, and so they need help. Morningstar says, and they do not address the coaching issue directly in this study, but they show that advisors add 1.6% per year, and there's another study that shows that advisors add 3% per year. So just want to leave this presentation with the following. I'm Ken Moore. Joey Hines is my partner. Adam Wiles is another partner. We just added a fourth advisor. His name is Kurt Schumacher, and he is a Harvard Law graduate. He will be a wealth transition strategist for our team, and I hope to introduce you guys to him soon. For TD Ameritrade referral partners, we will be, for $1 million plus, offering an estate plan, a turnkey estate plan solution also included in our fee. So thank you very much for your time today, and we look forward to working with you.